Now, when we talk about recession, nobody in their right mind really knows when a recession is going to happen, but we have a lot of data points that we can look at and try to make an educated guess. And one of the most important data points, because it's nobody's opinion, Welcome back in, everybody. In this video, we're going to talk about a deeply undervalued stock that used to be a Chinese headquartered company, now headquartered in California, trades for an under $1 billion market cap, and just recently got introduced to the Russell 2000. The company is profitable and consistently growing top-line revenue by over 50%. Now, before we get into this stock, I did have a question recently about how you should be positioned or what should you be doing if you think we're going to go into a slowdown and or possible recession. So we're going to talk about that as well. If you like this type of analysis, make sure you like and subscribe, and let's get into today's video. Now, the company we're going to talk about is GigaCloud Technology, ticker symbol GCT. What does this company do? This company is really a niche operator for drop shipping, and specifically drop shipping large items, fitness equipment, furniture, more of your large parcel categories. Their global marketplace connects manufacturers in Asia with the resellers in the US and the UK, Germany, Japan, and this is to execute cross-border transactions confidently, quickly, and efficiently. So they have these large ticketed items, they store these large ticketed items in a safe place, so when they're resold through different marketplaces, they deliver the products through third-party deliveries. Now, there is a lot of drama and question marks built with this company. This company was kind of considered a meme stock, an untrusted company due to the fact that they were stationed in China, but now they want to regain legitimacy, and that's why they are headquarters in California. A company by the name of Culpa Research has made it publicly clear that they are short this stock, and that's why there's a massive short position of over 17% short position in this company, which has dropped the valuation so low that it's basically trading at 6 to 7 times forward earnings. But the one thing you cannot deny about this company is the tremendous growth here. Take a look at this top line revenue, doing $275 million to now doing nearly $1 billion of top line revenue. And the great thing is all the fundamentals are following that top line revenue. Over 10% free cash flow yield, solid EBITDA margins, and a great job of deploying capital. Over 38% on return of equity, over 11% on return on assets, and over 13.5% on return on invested capital. So overall, the company is deploying capital well, it's growing top line revenue. When we look at the fundamentals, it's definitely an interesting point, but very, very volatile. This stock was kind of considered a meme stock because of how volatile the price action has went. As low as $6 a share, as high as $62 a share. And when we look at forecasts, we have a low of $35 and a high of $69. The stock is currently trading well below that at $22 a share. And this company has a picture perfect revenue and earnings following. Now, the biggest question is this a fraudulent company? Are we being lied to? I think now with it being in the US and having to deal with more strict accounting principles, and the fact that it was inducted into the Russell 2000 kind of props it back up to being a legitimate company at this point in time, in my personal opinion. And now we're looking at a company that has shown substantial growth, shown substantial earnings growth, being priced at a reasonable valuation, and earnings are going to absolutely deteriorate and slow down. So we're going to start plugging these numbers in to figure out what we want to pay for this stock. Now, of course, this is my opinion and what I believe the company is capable of doing. So always do your own due diligence. This is not financial advice. This is just my opinion. So when we look at market cap, once again, under $1 billion market cap, now the company is on pace to do over $1 billion in top line revenue. We bring that down to a free cash flow standpoint, and they're doing over $110 million in free cash flow. Now, total debt has shot up from $148 million of total debt to now $403 million of total debt. I believe this was due to an acquisition that they recently have had, but they still have $183 million of cash liquid. So when I look at this balance sheet, yes, that debt has exploded, but overall, not anything that I would be scared of. With about 2.5 years of free cash flow and the cash that they have in the balance sheet, they can completely knock out all the debt that they have. Now, stock analysis has them growing 25% and doing almost $4 of earnings. Yahoo has them growing right around 32%. And I just wanted to pull up their current report here to show you guys on their recent earnings report. They did $280 million in 6 months ended on 2023, now doing $561 million in 2024, basically doing over $300 million a quarter, possibly going forward. So they can definitely clear over $1 billion of revenue here, but I'm still going to err on a little bit of caution here because of the consumer. So the growth rates I'm going to personally use is about 10%, 5%, and 3%. Now, if we want to just do some quick paper math here and say that this is a company that's going to trade between 8 to 10 times earnings, we'll keep the same multiple that it currently has on it. And we'll say that they earn right around $3.50. We put an 8 multiple on that. We're looking at a $28 stock, which means that over the next year, we could see a 20 to 25% increase in just capital appreciation alone. Now, if they can do closer to that $3.85 to $3.90 a share, we multiply that by 8 once again, we're looking at a $30.80 stock. But if somehow the multiple starts expanding on this stock, which I think it should, this is probably a company that should be trading well above 12 to 13 times earnings, just do basically off of how much growth is ahead for this company and how fast that they're growing. There should be a premium being paid for this, and there is not. So if we take that same 385 and we just put a 10 multiple on that, well, we're looking at a $38 stock. Just doing some quick paper math here, it's clearly to see that this stock could be tremendously undervalued going forward, and we're going to just plug in our numbers and see what we come up with. Once again, when we compare valuation to their peers trading at 8 times earnings versus 17, 18 times earnings, obviously this thing is on sale, and it could be because that it's a small cap company, that there's questions about it being a legitimate company. So I'm getting between 23 to basically a $35 price target here when we look at it from a free cash flow standpoint, and that's building a double-digit rate of return in those analysis, with a future value sitting closer to $45 to maybe even $50 a share, depending on how fast you think this company can grow. Now, once again, I'm using pretty benign growth rates here, but I can definitely tick up a few growth rates and just say consistently they could probably do for the next 1 to 6 years closer to a 10% growth rate and possibly even more going forward. So even if we bump up our growth rates a little bit, you guys can see here, we're probably looking closer to a $30 price target on this company. So guys, I'm going to say that anything $22 and below on this company is extremely interesting here. And we're looking at a company that should be able to grow EPS by double digits, should still be able to grow top line revenue, high single digits, and the free cash flow margins seem very reasonable in this company. So this is a company that could possibly implement a dividend down the line, could buy back stock. A lot of flexibility with the clean balance sheet that this company has, and the niche that they're in, I think is pretty interesting overall. So that was my dive into GigaCloud Technologies, ticker symbol GCT. Pretty interesting stock, definitely one I'm going to put on the watch list. And if we go into some harder times here and this thing absolutely sells off, but the fundamentals look still reasonable in it, this is going to be one that you want to own going into an easing cycle once again. So if we do head into recession, we can see something like this obviously sell off, because people are not going to be buying those high ticketed items. They're going to be probably paying cost to store these units, and then some of these products will be outdated. So there could be a lot of turmoil to cause this stock to actually go on sale. But if the fundamentals can remain intact through the hard times coming out of a recession, and when we look at a consumer that starts to strengthen once again, and actually even with the holiday season around the corner, this might be one that does extremely well during the holiday season. But this is one I actually think is pretty interesting and reasonably priced. And rightfully so, because there's a lot of questions about the business itself being legitimate, and it's discounted for those reasons, which is now going to lead us into talking about possible recession. And one of the most important data points, because it's nobody's opinion, this has been something that's actually worked consistently, is when we look at the inverted yield curve, specifically the 2s to 10s and the 3-month to 10-year treasury. When we look at this inversion, history has shown us that that has been the most accurate dictator of when a recession is possibly going to happen. And so if we just take our bias out of the equation, if we just take all the market volatility and put it to the back burner here and just say, well, listen, every time that this inversion takes place since 1980, it's been pretty accurate here. We get an inverted yield curve and we go into recession. These gray bars behind the inverted yield curve are when recessions finally happen. But every time that we get an inversion, we see a recession take place. Now, of course, this time could be different, and because all eyes are on this inversion, maybe we do avoid recession. But there's differences between lagging indicators and leading indicators. Inverted yield curve is a leading indicator, meaning that things feel fine, everything seems all right, but this has been proven to be an indicator that has been extremely accurate. The 3s to 10 is 100% accurate. The 3 to 10 is heavily inverted right now. The 2s to 10 is starting to unwind, as we can see by this chart. We're starting to see yields starting to normalize here, and what ends up happening? Well, a few months following that is when we normally see recessions. Anywhere between 8 to 12 months, call it. And if you've been following the channel, guys, you know that I believe by the middle to end of next year, we will be in a pretty tough time, a pretty hard recession because of how steep and deep that this inversion took place. And the fact that there is a lot of euphoric and financial dysfunction taking place in the market that I think needs to get corrected. And normally those corrections happen pretty violently. And say maybe recession doesn't happen, but maybe it does. Odds are most likely it will happen because there's a lot of things pointing to that happening. So if we take our emotions off the table and we kind of just look at historical data points, the historical data points are saying that at some point next year, we're probably going to be in some sort of recession. That's me taking emotions out of the equation. That's me taking opinions out of the equation. Those are just facts that are pointing to what could possibly happen. Now, what's the first indicator that we're going to notice that's going to be a lagging indicator is going to be the labor market. And yes, while labor markets are historically low, we're starting to see them start to tick up here. In January through April of 2023, we were basically looking at 3.4% unemployment. And then now that unemployment has moved all the way up to 4.3%, still historically low. But what I want to point out is unemployment doesn't necessarily need to tick that high for us to be in a confirmed recession. Take a look at the dot-com bubble. It was at 3.9, shot up to 5.5, and then we were in a confirmed recession. And even in the 50s, was at 2.6%, shot up to 4.9%, we were in a recession. And even when we look in the 70s, we were at 3.5, basically where we are today, and shot up to 5.4. So we're not that, in my opinion, we don't need to move that much further up in unemployment for this to kind of solidify my thesis that I think by the end of next year, we will be in some sort of recession. I honestly believe a tick up above 5% is going to be plenty because of the amount of inflation that's happened. When we factor in what we're paying for gas, what we're paying for groceries, I don't necessarily believe unemployment needs to tick up that much to impact us because of how much is eroding from inflation. Most people are needing to work 1.5 to 2 jobs right now to make ends meet. So in my opinion, unemployment ticking up a little bit is going to go a long way when we talk about a recession. We're also in this gig economy, no pun intended from the stock that I just did, where you can sign up for Uber, you can sign up for Lyft, you can sign up for Uber Eats. You basically can create many jobs in a very short period of time. And that has falsely propped up the economy because that's all services based, which means that if people stop traveling and people stay home, well, there's not going to be as many Uber Eats out there and there's not going to be as many Uber rides needed, which means that incomes are going to come down and services specifically are going to come down because not as many bartenders are going to be needed, not as many waitresses are going to be as needed. So we could see services really take a drastic hit very quick. This will be something that takes place almost instantly when the consumer finally taps out or is scared to go spend. The other thing that's been really fishy with the labor markets is a big portion of the labor markets that's been showing job demand has been government, healthcare, and services. 3 areas that we can kind of prop up temporarily. Government jobs don't necessarily need to be there all the time unless the government wants to keep spending, which we all know that they're probably not going to be spending as much. So those government jobs, I think, are probably going to disappear pretty soon. Then we talk about the services jobs. We obviously know that the consumer debt is piling up and the consumer is slowing down, so not as many services jobs are going to be needed. So there's 2 holes I can kind of poke in the labor markets as of late. But as I showed you guys from this chart, we don't necessarily need unemployment to skyrocket for us to be in a recession. When we think about tough times or heading into possibly a bear market and or a recession, what are some areas we kind of want to stay focused on are utilities, staples, healthcare, and I would like to throw energy in there as well because I think the knee-jerk reaction of heading into a recession, we're going to see energy absolutely tank because the demand's going to slow down. But I also think there's great balance sheets in a lot of the energy sector, and I do think energy is going to be needed. So this could be an area that I also think could do well. So I would like to throw energy along with healthcare, staples, and utilities. But the next thing I really want to do is take a look at what sectors have done what over the last 6 months, call it. And the first thing I want to point out is the fact that utilities are leading the way at 21.5% return for the sector in 6 months. That is absolutely unheard of. And so when we take a look at defensiveness, it looks like a lot of money is already starting to position itself towards utilities, and even consumer staples are up right around 10%. Consumer discretion is lagging. Healthcare is definitely lagging. Materials are definitely lagging as well. And energy is kind of in the middle here. Now, I've done multiple videos on some interesting stocks that I thought have sold off. We talked about Pfizer when it was trading around $25. We also talked about Bristol Myers Squibb when it got down to $39 a share not that long ago. Now the stock is knocking on $50 a share in a very, very short period of time. This was a company that was paying over a 6% dividend, so you literally only needed about 3.5 to 4% equity returns to get a market rate of return on a company like Bristol Myers Squibb. And same thing can be said for Pfizer. 6% coming from a dividend, well, you basically only need about 5 to 6% more to come from the actual stock every year, which is not really asking a lot to have market returns within those two names. And so I still can make the case for healthcare being a little bit overlooked, a little bit undervalued, especially when we talk about companies like Johnson & Johnson, CVS, Pfizer. These companies have kind of been trading choppy, but if you're able to buy them on these big dips, you're able to get a really, really high dividend yield, and you're also able to get pretty substantial equity returns, I think, when you're looking 5+ years out. Now, another area I really think you need to be considering to get away from the equity risk is actually just fixed income ETFs. There's a lot of fixed income ETFs that are out there that are yielding anywhere between 5 to call it 6%, some as high as 7%. So the higher risk you want to go onto those yields, the more return you can get, but the more volatile the actual price of that ETF will be. So you can definitely get something that yields 5.5 to maybe even 5.8%. That's going to have very, very low volatility when it comes to the price. And so I would be overweight. I would be overweight maybe 3 to 6 months treasuries. I'd be overweight cash, just staying in strictly cash right now. I'd be overweight healthcare, staples, utilities, and I'd be overweight fixed income ETFs at this point in time. Sit back, collect those yields. The market could hit newer highs, but we're talking about maybe the market has another 5 to 10% move in it. And my fear is if we do go into recession, the downside risk could be 30 to 40% in this market. And I know most people are thinking that sounds ridiculous, but earnings are setting up to be extremely aggressive next year. And if the consumer taps out, I think earnings estimates are way off the mark if we do go into some sort of slowdown and or recession by next year, which then throws off the thesis for 2026 being an AI boom and companies really excelling in 2026 with capital expenditures that are going to take place in 2025. So it'll be interesting to see how this all unfolds, but kind of wanted to give you guys my 2 cents of positioning going into a possible choppy end of 2025. So I'd be looking to possibly start taking profits, writing some calls. If you're up in some positions, I'm not saying sell out of these positions. Always keep your winners and try to get rid of your losers as fast as possible. But there's nothing wrong with taking some profits and locking it up in 6.5 to possibly 7% on some of the fixed income ETFs and set it and forget it. And if opportunities present themselves, then you have that capital working for you to deploy it once again. Once again, guys, this is just my opinion, but we'll see you in the next one.